shares of PacWest Bancorp on the rise this morning, jumping more than 7% on news. The regional bank sold a $3.5 billion loan portfolio to Ares Capital. PacWest says the deal will improve its liquidity as the regional lender moves to focus more on relationship-based community banking. This as the Fed is expected to release results from its annual banking stress test Wednesday, an assessment of banks' ability to withstand crisis. The results come just months after the collapse of several regional lenders and amid chatter of a possible recession on the horizon. Let's bring back in Tony Dwyer, Canaccord Genuity, a chief market strategist. So let's talk about these stress tests. Of course, this latest round, kind of the formula was created before the regional banking crisis. Do you think it's enough to address where the banks stand right now?
Well, Diane, this was never a bank crisis. Right. It was a regional. There's some regional banks that definitely were in crisis, obviously. But the major banks that are subject to these stress tests are well capitalized. So it wasn't about whether the banks were going to fail. That was the last cycle. To me, this is all about is the regional bank issues going to increase or decrease the willingness of banks to lend? We were in a bank lending standards going into at the most recent survey, which was January, prior to the regional bank issues, were already in a level that would suggest a recession. So did the Silicon Valley Bank issues, the stress tests, the fears of increased capital needs, is that going to make them want to lend more or less money? And I would think it's going to make them want to lend less money, which again goes back to my prior points of what really drives the market from here is economic fear.
So it sounds like we should be paying more attention to those regional bank surveys, right? Or those quarterly bank surveys, I should say, about loan officers than we should necessarily to the stress tests.
Yeah, Julie, it's really listening to the bank management conference calls. Right. I'm not a bank analyst, so similar to the Russia comment, I'm not going to pretend to be one on TV. What I do know is that it's a human nature call. If they're telling you, if you're fearful that you're going to lose money, they're going to increase your capital needs from a regulatory perspective, and you're going to get all this scrutiny about what you have on your balance sheet. That if I'm the head of a bank, I'm not sitting there saying, okay, let's go take more risky loans, especially because I have an inversion of the yield curve. So ultimately, that's why, Julie, you asked the exact right question. What changes the tune? And all of it changes with a short-term interest rate environment where you see a dramatic drop in rates because that fixes a lot of the problems making money more available.
But sorry, if I can just jump in here. It doesn't sound like that's going to happen, though, anytime soon, the drop in short-term interest rates.
Well, now that everybody's priced it out, remember there were 4 rate cuts priced into the market about a month ago, which tells you how smart the market is on the Fed funds futures. But that can change really quickly. You're going to have a combination of a pretty dramatic reduction in inflation and a rise in unemployment, and that will create a Fed. I'll tell you the language that I think will end up happening. They've been focused on this. We've got to get to 2% or until we see the whites of the eyes at 2%. Well, how about if you're trending lower on the core inflation rate while unemployment is going up? I could see the language of the Fed dropping rates because inflation's trending properly, and we now have an increase in employment that takes the wage pressures off it. And you could see how the Fed could surround potential rate cuts either later this year or into early next year. Things happen quickly. When you look at the unemployment rate or other economic indicators, they go bad quickly. It doesn't look like it, doesn't feel like it, but that's what can happen.
Tony, the Fed talked a lot about its failures, if you will, with regard to the regional banking, for lack of a better word, crisis. And we know that the stress test came about because of the financial crisis, 07, 08, 09. Do you expect further regulation to come as a result of kind of this wave of what we've seen within the banking sector?
I would bet so. How that looks will depend upon the makeup of Congress as we go through the election, because it typically comes well after the fact, because you have to have a lot of subcommittees interview and really get all the data in place so they can make a decision. But that's already I don't want to say too late. It's already going to be priced into the market. Think about, I was around during the savings and loan crisis in the late 1980s, early 1990s, where you set up the Resolution Trust Corporation that increased regulation in that framework. Then of course, you had the dot-com bust. Then you had the global financial crisis. So Diane, every major economic-based market decline typically surrounds the bank because the Fed inverts the curve. Like think about Jerome Powell talked, and I thought he gave a great analogy. He said, they were on a highway. They were going really fast. Okay, they're getting toward their destination. They're going to slow down. Well, what if they get past the destination and they have to slam on the brakes and do a skidding turn? Right? That typically is what happens, which creates the issues that you have in some segment of finance that gets regulated after the fact.
Tony, by the way, there's no way you could have been around during the savings and loan crisis. You were still in elementary school at that point.
Yeah, I was in middle school. Yeah, I'm a millennial. Can't you tell?
Just one more quick question when it comes to how all of this relates to the financials. I know you're mostly a macro guy, but how are you positioned in the financials right now? Is that neutral rating? Is it something you want to avoid?
So our call, Julie, has been, I call it being light and tight. We're 18 months into this, 16 months into this. I don't want to be really negative. I want to be able to take advantage of weakness. So I would be a slight underweight in the financials. They're not acting well. They haven't. The financials are a great example. You're going to get negative on the financials now? Like they haven't rallied. They're down. The relative performance is horrible. So it's a place that once you get into this recessionary where it becomes clear that you're going into a recession, I want to take advantage of them. So I don't want to bet on the downside. I want to stand ready to take advantage of it. And that would include the financials.